This one piece of paper can save you thousands of dollars on your mortgage. Or if you don't know how to read it, quietly cost you thousands. Today, you're going to learn to read every line of it. So you applied for a mortgage, and a few days later, the lender sends you this 3-page PDF called a loan estimate. You open it, and it's a wall of boxes and numbers, and you have no idea what you're looking at. Take a breath. I'm David Lurvy, a licensed mortgage broker, and I want to walk you through this form, line by line, defining every word as we go. By the end, you'll read one with total confidence. Here's the first thing that helps. This form isn't your lender's invention. It was created by the Consumer Financial Protection Bureau under a rule called Know Before You Owe. Back in October of 2015, it replaced the old good faith estimate, and by law, your lender has to give it to you within 3 business days of getting your application. A business day just means a day the lender is open. Here's the insider tip most people miss. Because every lender uses this exact same form, you can get a loan estimate from 3 lenders and lay them side by side. That is its superpower. Same boxes, same order, apples to apples. Let's start at the top of page 1. The header has your lender, the date it was issued, the applicants, the property address, the sale price, and your loan term. Term just means how long you have to pay the loan back. For example, 30 years. It shows the purpose, which here is purchase, the product, like a fixed rate, which means your interest rate stays the same the whole time, and the loan type, like conventional FHA or VA. Those are just different loan programs, and which one you have was decided when you applied, so don't worry about the letters here. There's a loan ID number and a rate lock line that says yes or no. With the date, your locked rate would expire if you don't close in time. Locked just means your rate is held in place. Below that is the loan terms box, and this one matters. It shows your loan amount, the money you're borrowing, your interest rate, the yearly rate charged on the money you borrow before any fees, and your monthly principal and interest. Principal is the amount you borrowed. Interest is the cost of borrowing it. So this line is the part of your payment that covers both. Now look at the column on the right that asks, can this amount increase after closing? Closing just means the final day you sign all the paperwork and the loan becomes official. On a simple fixed-rate loan, the answers here are no, no, and no. That's a good thing. The same box lists prepayment penalty and balloon payment. A prepayment penalty is a fee for paying your loan off early. A balloon payment is one big lump sum due at the end. On a straightforward fixed loan, both say no. Next is projected payments. This builds your estimated total monthly payment from a few pieces. Your principal and interest, plus mortgage insurance if you have it, which protects the lender if your down payment is small. Your down payment is the chunk of the price you pay yourself up front out of pocket. Then plus estimated escrow. Escrow just means the lender collects a slice of your property taxes and homeowner's insurance every month and pays those bills for you. Let me make that concrete, and the rate here is just an example, like I always say. Picture a $300,000 loan at an example rate of 6.5%. The principal and interest comes to about $1,896 a month. Then mortgage insurance and escrow get stacked on top to reach your real total. And heads up, taxes and insurance can rise over time. Last on page 1 is costs at closing. 2 numbers, your estimated closing costs and your estimated cash to close, which is the total cash you actually bring on the day you sign. Page 1 done. Page 2 breaks down every cost. The top half is loan costs. Section A is origination charges, the lender's own fees and any points, like an underwriting fee of $1,295 and a processing fee of $1,000. Section B is services you cannot shop for, things like the appraisal fee, around $550, and a credit report fee of $150. Section C is services you can shop for, like title services, pest inspection, and survey. This is your save money zone. You're allowed to shop Section C and pick your own providers. Section D adds those up into your total loan costs. The bottom half is other costs. Section E is taxes and government fees, like recording fees and, in many states, transfer taxes. And here's something worth knowing. Not every state charges a transfer tax, so depending on where you're buying, this line might be smaller or not there at all. Section F is prepaids, things you pay up front, like prepaid interest, which is the interest from your signing day to the end of the month, plus homeowner's insurance and property taxes. Section G is your initial escrow payment, the starting deposit into that escrow account. Section H is other, often optional owner's title insurance. Section 1 totals those, and Section J is your total closing costs. Then a calculating cash to close section shows the math. It starts with your closing costs and your down payment. Then it subtracts your deposit, which is money you already put down to hold the home, and any credits, which is money the lender or seller is giving you. What's left is the cash you actually owe, and here's the calm version of a rule people overcomplicate. Some of these costs cannot change at closing. Some can change only a little, and some can change more. It is an estimate made in good faith, not a trap. Page 2. Done. Page 3 is where you compare. The comparisons box shows in 5 years, meaning how much you'll have paid in total, and how much of what you borrowed, your principal, you'll have actually paid off by then. That number is smaller than you'd expect because early payments lean heavily toward interest. That's normal. Then APR, your annual percentage rate. Think of the interest rate as the cost of the money alone, and the APR as the cost of the money, plus the lender's fees, blended into one yearly number. That's why the APR is usually a little higher than your interest rate. And TIP, the total interest percentage. That's all the interest you'd pay over the full life of the loan as a percent of what you borrowed. It looks big, but that's total interest over 30 years, not your rate. Below that, other considerations covers the appraisal, assumption, homeowner's insurance, late payment, refinance, and servicing, which just means who you send your payment to. And right here, the most reassuring part. If there's a confirm receipt line and you sign it, that only confirms you received the form. It does not mean you accepted the loan. You are not locked into anything. So here's the single most useful thing you can do. Get loan estimates from a few lenders and lay the matching boxes side by side. That's how you find the real best deal. Then save your favorite because later you'll get a closing disclosure, the near final form you must receive at least 3 business days before closing, and you'll check that the numbers still match. One quick note, this is education, not financial advice for your specific situation, since every loan is different. If this made the loan estimate click for you, subscribe. Next up in the series, we'll break down the closing disclosure and show you exactly how to compare the two. Thanks for watching, and I'll see you in the next one.